Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, March 30th, 4:48 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, leaders continue to stay strong. Those are flashing bullish. Short term. Get off of there. Short term, we are neutral pointing toward bullish. S&P 500 and NASDAQ handling their 21-day moving averages just fine. It's the other indexes that are struggling. We'll take a look at that when we get to the charts. Medium term, second close for the S&P 500 above the 50-day moving average. So good stuff there. Qs have been leading above it for a while. We want to see how we close the week. If the S&P can close the week above the 50-day moving average, we'll go to neutral. Long term, also neutral, but again, as if I'm a broken record, the S&P 500 and the NASDAQ 100 handling their 200-day moving averages just fine. So what happened today? Did I say state of the market? I didn't. State of the market. We're in an uptrend, excluding financials and real estate. And when we go through some charts toward the end, we're going to talk about ETFs for shorting banks and real estate. So what happened today? Another gap up overnight, but it faded, and it was fading as there was some negative news for banks that came out. And it started with somebody tweeting about ticker MCB and about how bad their commercial real estate portfolio is. They're a West Coast bank, and it kind of caught on. And after being up early, the bank ETFs faded, as did small caps. Strengthened to the close, however, but you see banks and small caps in the red. Here are the numbers on the day. The RG7, this is the Revere Growth 7 ETF composite, up 0.17%. S&P up 0.6. Gapped up 0.6, closed up just about 0.6. So we were where we started. That was pretty much the same situation as yesterday, a little bit stronger toward the end, though. NASDAQ 100 up nearly 1%. Dow up 0.4. Mid caps up 0.26. Russell in the negative, as mentioned. Global 60/40. Stock and bond up 0.53%. In-house GROTECTION up 0.38%. Some of our stocks are extended and pulling back. And then we have one that was a leader that looks like it's undergoing a little bit of distribution, but it could be just consolidating for a move higher. We'll point that out when we get to the charts. So let's dive into it. We'll go through the state of the tail of the tape, and then get into the charts. S&P 500, you can see second straight day here. Let's bring up the 5-minute for the interactive view, intraday view. Here's your second straight gap up. Anytime you have second straight gap up, you know you've got to be worried about not going much higher. Definitely the worst time to plunge in is when you have another gap up after, especially after closing strength. It's considered a continuation, and it's often a source of exhaustion. You kind of saw the exhaustion yesterday too in the morning. Gap up, couldn't go much higher, sideways for a couple of hours, couple more hours, and then some strength into the close. Today, kind of similar, but some weakness intraday, as I mentioned, with the banks. Gap up, a little bit of a harsh pullback. It's only 15 points. It looks worse than it really is. On the chart, back up sideways, and then just a trend, a lower highs and lower lows, trending lower, down to 40.32. Yesterday's high was 40.31, so basically filling the gap, not quite. And then the market decided that was far enough. We're going to start doing some buying into the close from 40.32 up to 40.49, and then closing at 40.51. All in all, another win for the bulls, but not if you're a bull on banks and small caps. We'll show that momentarily. So let's take a look at the moving averages here. We're 3% above the 200-day moving average now. We've hooked back up on the 21, and our second close above the red line, that's the 50-day moving average, where we're now almost 1% above. 1.8% above the 21, which again is just now hooking up. We want to get this back above the 50-day moving average so that the indices are aligned correctly. Note this when you step back and take a look at this, this has been a pretty decent move off of this 3808 bank crisis shakeout. So 250 points off of 3808, basically reclaiming the moving averages, a couple of missteps along the way, but all in all, big tech leading that. And after a little bit of a rest for big tech last week and Monday and Tuesday of this week, they righted themselves starting yesterday, leading the breakout today. Here you see the negative reversal, 322. That was with the Fed, pulled back, didn't even get to the 21 on the Qs. SOX, which had been the strongest index, pulled all the way back to the 50-day moving average. But two nice days up here for the NASDAQ 100. Very clearly new highs are not bearish. Let's go to the Dow Jones Industrial Average. Here's the DIA. Two closes above the 21 now. Very nice. That's four closes above the 200 coming into the declining 50-day moving average. MDY fared better than small caps. Closed just below the 21-day moving average. You can see the stochastic finally favorable. But this is 5 days up for mid caps after the Friday, what now looks like, and it needs to hold, the bank shakeout. But as today proved, not all things are clear for the banks. Here's the IWM. Small caps rejected at the declining 21-day moving average and closed negative. Here's the 5-minute chart. It gapped up too nicely, along with the big caps, and the rest of the indexes gapped up 0.7%, made higher highs. But then the pullback was not as kind, and neither was the strength into the close as it was for the bigger caps. You can see the pullback here and finishing the day negative. For now, it's a rejection at the declining 21-day moving average back into the banking banking crisis base, we'll call it, which is kind of in line with the bottom that was formed back in late December for banks. Let's go to the dollar. Dollar weak again today. In fact, this is close to new closing lows. If it's not a new closing low, no, not quite. 27.78, below the 21, below the 50, below the 8. The weak dollar has been good for stocks. The last 2 days were oversold and heading lower on the stochastic. Let's go to the VIX. The VIX was up today as that fear crept in the afternoon back into the market. So you can see it here. This fear creeping higher coincided with the pullback in the banks, but we topped at 20, sold off nicely into the close. That corresponded with the strength into the close on the major indexes. So there's your VIX below the 21, below the 50-day, and below that 20 level. But this is a big support area. We could go down, we're at 19. 1706 was the ultimate low of this most recent leg up before the bank issues kicked in. Let's flip to bonds now. Bonds didn't do a whole lot today, again, for the third straight day. In fact, if you look at a 15-minute chart, you can tell how tight this has been since the gap down on Monday. In bonds meant gap down, price down meant yields higher. But in this case, that was kind of a relief because the yields were being bid up based on fear last week until the last of that fear shook out Friday morning. So there's the overall bond index, continued tight action. Let's go to corporate bonds, LQD, pretty much the same. Long-term bond, TLT, up the most of the bond indexes. It's the most volatile, as the long term usually is, up 0.46. Still, again, trading in a very tight range. Here's the 15-minute chart again, very tight range between 104, 105, 80-ish. Again, the gap down. And here was the shakeout Friday morning with that corresponded with the high-end yields. Let's take a look at those yields now. TYX, the 30-year, sitting on the 21 and the 50-day moving average, pulling back for the second straight day. The 10-year, the TNX, second straight day, yeah, down today 0.42%. Again, we're in this tight range here, but the bottom line is that the shakeout is still intact. on the 10-year, the low in yields, meaning also the high in money flowing into bonds. And now we need to get back to trading like we're more in sync with what the Fed and the economy wants to do. But speaking of that, we've got a decent report tomorrow, PCE inflation data before the market opens. We got to keep an eye on that. So, with the dollar weak, we would expect some good stuff from the precious metals, and we got it. Here's gold up nearly 1%. Here's gold stocks, GDX, continuing to climb higher along the 8 EMA, up 1.5% today. Silver, SLV, up 2.3% today, again, climbing up the 8 EMA, getting back near where where it based before breaking down in early February. And finally, let's go to Bitcoin, BITO down 1.5%. It's also in a 2-week base. So those are the major indexes that we look at. Here's the tail of the tape. You can freeze this if you want to read through it in detail. One thing I do want to point out, the NASDAQ McClellan Summation Index RSI has hooked up. We watch this very closely. It's a fantastic signifier. It trends strongly, and it's one of the most reliable signals once it starts trending uh, that we follow. So we'll put this at the top of the secondary indicators, and it's now flashing positive. So uh, certainly good stuff for stocks. So we're back to the bull case now with yesterday's follow through day. Multiple closes above the 21E, also reclaiming the 50-day moving average. Day count went from up 3 out of 4 to up 4 out of 5. 8 EMA. The 8 EMA and the 21 EMA were now at a +5 on these. FOMC rate hike odds. FOMC meeting is May 3rd. No hike, 51%, 25 basis points, 49%. There was also a Fed head out speaking today, talking that she thought we needed one more 25 basis point hike. That had a little something to do with the sell off, as well as what was going on with that bank. Expectations positive, as long as we're over the 21. That's confirmed. We got into this 40-60 resistance area, but reversed off there. But the NASDAQ 100 cleared this resistance area, and also first close, it was only a dime, but first close above this big 315.59 Fibonacci level that had served as resistance for quite a while. Here's the intraday trend. Here are the strong and the weak sectors. Here's what we own in the portfolio, highlighted in blue. Today we added to UPRO on the pullback. And when it started, a little bit on the pullback and then a little bit on the bounce off of the 40.32 low. We're positive on all 4 buys of UPRO now. And these are the ETFs that we're going to discuss for shorting real estate and for banks. Yeah, we might be late talking about this, or it could be the way to hedge being long the S&P 500. Ultimately, you take your signal, you set your stop. You're going to be wrong half the time. You keep your loss small. You let your winner run. That's We wouldn't treat this any different than we treat any of the index longs or individual position names that we do. Bottom line, our portfolio went up from 1.18 risk to 1.33 today, so basically 33% more exposure than the S&P 500, more risk than the S&P 500, but the standard deviation is wider because we've got about half in stocks and half in. We've got 20% UPRO. That's the equivalent of 60% in the S&P 500. So we're looking to basically it's a 60-40 portfolio. 60% S&P 500, 40% short-term treasuries, and then the rest is alpha that we're looking for by these stocks. That's how we work it when the trend is in our favor. Bottom line today, gap up fades, but we pull back near yesterday's high and then strength into the close. Banks and small caps weak. Let's go to some charts now. First, we'll talk about ANET, which no, talking about the character change with this. This rode the ADMA up nicely. We took some profits here when it was extended. It continued to go higher into this profit-taking zone, and then it gapped down on Tuesday in spite of what the market was doing and hasn't made any progress despite strength in the market the last 2 days. And I don't like that the volume has been average or above average during the sell-off. If you go out on a weekly chart, this looks like absolutely nothing. You could argue that you should be taking profits here. And we did back in here. It was about a 15% gain. We got up to the 20%, 21% before reversing. Uh, Basically, this is forming a triangle, and if it breaks the low of 161, we'll sell the add-on for a couple percent loss, and we'll continue to hold. We're above our cost basis now. The 50-day moving average is above our cost basis. We'll continue to hold that last piece that we bought until it breaks the 21E. Okay, so that's ANET. Now here's the stock that caused problems today, MCB. Metropolitan Bank. It says Bank Northeast. Okay, it's a Northeast bank, but what I read is that they've got a lot of loans out west. That may or may not be the case. In fact, I may be confusing it with another bank that was down today, but is not as prominent as MCB. MCB is in the KRE ETF, the regional bank ETF. I've got a big list of them that I look through, and this is obviously looked like a massive shakeout with the big gap down. This was with SIVB and all the weakness and fear in a certain banking sector. They also have crypto exposure, and crypto and commercial real estate, not a good combination. So after that, what looked like a false breakdown, it formed a triangle, and that triangle broke lower today on massive volume, down 27.58%. Off the bottom, it closed, the low was down near 22. But we don't like to see these daily blowups because they bring fear into the market. Whether it's legitimate fear or not, we don't know, but we want this crisis to be put in the rearview mirror, quite obviously. But KRE can't seem to shake the fears and work its way anywhere near even the 21-day declining moving average. So let's talk about these ETFs now. Uh, let's start with the banks. So the three to focus on are XLF. This is broader. This has more financials. Hasn't gotten to the declining 21 yet. When you short, you want to use the long ETFs to make your decisions because the shorts, they could be if they're levered, they're not going to act one on one. They reset every day, and you don't go by the chart of the derivative, you go by the chart of the underlying. So here's XLF. You've also got IYF, another financial index, looks pretty much the same as this. And then you've got KBE, and then you've got KRE. So very clear weakness on all these financials. And FAZ is the way to play this. Again, this looks great. It's almost, you could argue, hey, this is a buy off the 21-day moving average. Yeah, that's what it looks like it did. But again, you want to use the strength or the weakness of the XLF, IYF, KBE, and KRE to make your decisions for buying the inverse finance ETF. So those are the financials. Let's flip over now to real estate. A couple of real estate ETFs that signify the long. XLRE, it's one of the spider ETFs. You see it rallying off the lows into the declining 21 and pausing right there today. Here's another one, IYR, rallied into the 21, declining 21, and it paused right there. So real estate really wasn't an issue today. But if you want to play real estate short, DRV is a liquid three-time bear ETF. You can see it's pulled back to the 200-day moving average. Again, don't use the technicals from the DRV. You use it from IYR or XLRE. So basically, if you think real estate's going lower, this is a decent low risk, high reward to buy DRV to the downside with the assumption that IYR shouldn't go much above today's high. Let's look at a smaller term chart for this. IYR, you can see that it's also got resistance over here on March 21st. Let's go out a little bit more to the 30-minute moving average. You can see there's a cluster of resistance over here, and this was all post pullback March 15th. here before while it was trying to base before it had this last washout last Wednesday, Thursday, and Friday before going back to the upside. So IYR XLRE are the long, and on the short side, DRV is a way to play it, DRV long. And the reason why we don't short is because over 80% of our accounts are are Roth or IRA accounts. So you can't short in there. So that's why we play it consistently across the board with the inverse ETFs. If we're going to, we don't short individual names. That's going to wrap it. I didn't talk about what we do here at Revere, and I'm not going to close without doing it. But basically, we're trying to keep you out of this. These bear markets, these are capital destroyers. If you're approaching retirement, you don't have the time to get back to even if you get caught in a massive hit to your. Imagine you've got $1 million saved, and it's March 2000, and you were planning on retiring, and then by the end of 2022, you lost half your money. You've got to double your money to get back to normal. Last year, nowhere near as bad, quote unquote, only lost 27.5%. You need 38%. We've climbed back about half of that to get back to even, but we protect the capital on the downside and we let the upside take care of itself when the market gets to a more bullish posture. And you've seen us do this. You see how we do it. We do videos every night. You see what we're buying, what we're selling, and the approach to it. And if you're interested in that, and you want us to manage your account, reach out, Don at revereasset.com, or my partner, Dan Stewart, Dan at revereasset.com, or the phone is 855 Real Wealth. That's 855 732 5932. Don't tell me that I might be late on this. If I want to short the financials, I totally realized that the optimal place for this was up here at a break of the 35 level, but it wasn't evident everything that was going on. It looked like a normal break until here on 3.9, and at that point you're just too far down and you're at risk for a whipsaw back. It's not a low risk entry, and if it goes lower, we're just going to let it go lower. But again, obviously this was when it was just getting started. If I had a crystal ball, if I was in the rear view mirror, I would say, look how smart I am shorting it at the 50-day and 21-day breakdown. But we didn't do it. Yeah, we might be late with this, but if it's going to go lower, the risk reward is there, at least on the real estate side today, with this second gap up into the declining 21. That's going to wrap it. Remember, we discussed the short side and stops because it's not how much you make in the markets, it's how much of that you can keep. And with that, I will wrap up Thursday, March 30th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.